Imagine holding the key to your future, a key forged not of gold but of smart decisions. This isn't a fairy tale. It's the power of investing, a power often misunderstood and tragically delayed until adulthood. But what if teenagers, with their long time horizons and untapped potential, could unlock this power early? This isn't just about accumulating wealth. It's about building financial literacy, fostering responsibility, and planting the seeds of a secure future. This is a complete guide to investing for teens, a journey into the world of finance, demystified and made accessible. Picture this. You're 16, maybe with a part-time job or some birthday money burning a hole in your pocket. The latest video game or trendy gadget beckons, promising instant gratification. But what if instead of immediate pleasure, you chose to invest a portion of those funds, planting a seed that could blossom into a financial orchard years down the line? This isn't about sacrificing fun. It's about strategically allocating resources for greater rewards in the future. But where does a teenager even start? The first step is understanding the basics. Investing, at its core, is about putting your money to work, expecting it to generate more money over time. This can be achieved through various avenues, from stocks and bonds to real estate, and even starting your own business. But before diving into specific investments, it's crucial to grasp some fundamental concepts. One of the most powerful forces in investing is compounding. Imagine a snowball rolling down a hill, gathering more snow as it goes, growing larger and larger with each rotation. This is the essence of compounding, earning returns not only on your initial investment, but also on the accumulated interest or profits. This effect is exponentially more potent over longer periods. This is why teens have a unique advantage: time. A small amount invested today can grow significantly over decades thanks to compounding. Another vital concept is diversification. This means spreading your investments across different asset classes, industries, or even geographic regions. The logic is simple. Don't put all your eggs in one basket. If one investment performs poorly, others can cushion the blow. This principle helps mitigate risk and protect your portfolio from significant losses. But what exactly are these asset classes we're talking about? Let's explore some common investment vehicles. Stocks represent ownership in a company. When you buy stock, you become a shareholder, owning a small piece of that business. If the company performs well, its stock price rises and your investment grows. But stocks can also be volatile, meaning their prices can fluctuate significantly in the short term. This volatility can be scary, but it's an intrinsic part of the stock market. Bonds, on the other hand, are essentially loans you make to a company or government. They are generally considered less risky than stocks, offering a fixed interest rate and a return of your principal at a specified maturity date. This makes them a more stable investment option, but with potentially lower returns compared to stocks. But which one is right for a teenager? For teenagers with a long time horizon, stocks are generally considered a more suitable investment. The potential for higher returns over the long term outweighs the short-term volatility. However, it's crucial to invest in a diversified portfolio of stocks, rather than putting all your eggs in one company. Index funds, or ETFs, are a great option for beginners to achieve diversification. What are these mysterious acronyms? Index funds are investment funds that track a specific market index, such as the S&P 500. By investing in an index fund, you automatically own a small piece of hundreds of different companies, achieving instant diversification. ETFs, or exchange-traded funds, are similar to index funds, but are traded on stock exchanges like individual stocks, offering greater flexibility and liquidity. This ease of access makes them very attractive for young investors. Another investment avenue, often overlooked by teenagers, is investing in themselves. This means acquiring new skills, taking online courses, or even starting a small side hustle. This type of investment can pay off handsomely in the long run, increasing your earning potential and opening up new opportunities. This also can be a good way to start making money to invest. But let's talk about the elephant in the room. How can a teenager, often with limited funds, actually start investing? The answer is simpler than you might think. Many brokerage firms offer custodial accounts, which are investment accounts held in a minor's name, but managed by a parent or guardian until they reach legal age. These accounts allow teenagers to start investing with relatively small amounts of money. Furthermore, many brokerage platforms offer fractional shares, allowing you to buy a small portion of a single share of a company, even if you can't afford the full share price. This makes investing in even high-priced stocks accessible to teenagers with limited capital. This accessibility is a game changer. Now let's address some common concerns. Many teenagers might think they don't have enough money to start investing. But the truth is, even small amounts can make a big difference over time, thanks to the power of compounding. Starting early is far more important than the amount you invest initially. This principle can change the financial future of any young investor. Another common misconception is that investing is too complicated or risky. While investing does involve some risk, it's important to remember that doing nothing is also a risk. Inflation erodes the value of your money over time, so simply saving cash in a bank account can actually result in a loss of purchasing power. The key is to educate yourself, understand the risks involved, and invest responsibly. So, how does a teen actually choose their investments? It's important to do your research, understand the companies or assets you're investing in, and avoid making impulsive decisions based on hype or speculation. Learning the basics of financial analysis can be very helpful. Investing is a marathon, not a sprint. It's about building wealth gradually over time, through consistent contributions and smart investment choices. Don't get discouraged by short-term market fluctuations. Focus on the long-term potential of your investments. This long-term perspective is the most powerful tool a young investor has. Investing isn't just about making money, it's about building a foundation for your future. It's about achieving financial independence, pursuing your dreams, and creating a life of opportunity. By starting early, teenagers can harness the power of compounding, learn valuable financial skills, and set themselves up for a brighter financial future. The journey of 1,000 miles begins with a single step, and the journey to financial success begins with that first investment. Starting early can create a financial advantage that will last a lifetime. But youth does not last forever. That is why in the video that you have now on the screen, I explain to you what you should invest in according to your age.